All right. Today is Sunday, June 6th. This is a recap for the stock market activities last week and an outlook for this upcoming week. I hope everybody had a great weekend, and if you did not, that's okay because we have a new, fresh week coming. All you have to do is stand up, smack yourself in the face, and remind yourself that you're going to get them this time around. Where do we start? How about we start with inflation, specifically tapering, because this is what the market is fixated on right now. We have sub-stories, the like of AMC and Bitcoin, Tesla, but the main story remains inflation, and specifically tapering. The market is not entertained by the whole transitory or not transitory inflation. The market could care less about inflation. The market cares about tapering, and it uses inflation as a measure to adjust tapering expectations. And the market processes two pieces of data to measure inflation, and that in return measures tapering expectations. These two pieces of data are, number one, the jobs report, and number two, the CPI report. On Friday, we had an update for the first measure of inflation, which is the jobs report. And this is deja vu of last month, because last month the expectations were that the jobs report will come out hot, over 1 million jobs created. These were the expectations, but the real reading we got was about 266,000 jobs created. We're having deja vu here because once again, the number that was expected was also near 1 million jobs. And this time around, we got about 560,000 jobs. And remember, the market processes the jobs report and the CPI report. Then it creates an impression regarding inflation, and that impression will impact tapering expectations, which is the number one focus for the market right now. Will tapering happen this year, meaning sooner than most expect? Or will tapering happen later? And if tapering is going to happen sooner, then that will be good news for the stock market because the printing machine will continue to go on and on. The easy money policy will continue to go on, and that will specifically be good news for the NASDAQ because it revives the TINA argument. If inflation is rising slower than expected, then tapering will happen later than expected, and therefore yields will go down, and the risk versus reward will be in favor of the NASDAQ specifically, but the stock market in general. And therefore, that leads us to good economic news equals bad news for the stock market. Good news is bad news, and guess what? Bad news is also bad news. Let's start by good news is bad news. Had the employment report came out too hot, meaning creating 1 million jobs or more, then that will be an indicator for the market that inflation is rising hotter than expected, and that means that tapering will happen sooner than expected to control this inflation. Likewise, bad news is bad news, meaning if the number came out again way below expectations, meaning 200,000 jobs, even 300,000 jobs, that will be the indicator of wage inflation. And that again feeds inflation expectations higher, and that in turn feeds tapering expectations to happen sooner than expected. Of course, had the number came out at 200 or 300,000, that would have been a massive problem for the Federal Reserve because it will ignite the conversation whether the Fed's policy is even working, because the Fed said, let inflation rise higher, because if inflation rises higher, we will create more jobs. We will recover more and more jobs. That is the assumption. And therefore, that leads us to the kitchen at the Bureau of Labor Statistics. They knew ahead of time that a number too hot will be bad for the market, will not help the Fed's or the Biden administration's agenda. Likewise, if the number is too cool, that will ignite the wage inflation conversation, and that will be not good news for the Federal Reserve and the Biden administration. And therefore, the number came out magically right at the middle. A little over 500,000 jobs created, and that was the sweet spot for the stock market because it tells us that the Fed's policy is succeeding. They are recovering jobs, not fast enough, but they are recovering jobs, and inflation is not rising as high as a lot of people feared. And therefore, there was a win for the Federal Reserve and a win specifically for the NASDAQ, and the market reaction was abundantly clear. And remember this, the playbook. What will the market concentrate on? Will the market concentrate on inflation or tapering? Now we know that the market is concentrating on tapering. And I gave you the playbook if tapering was about to happen sooner than most expect. What happens if the opposite is true? If we get a jobs number that is right around the middle, as we got on Friday, then the inverse picture of that playbook takes place. The dollar index goes down, yields go down, and the triple Qs, the NASDAQ, surge higher, while commodities, gold, and the inflationary trade become mixed. This is exactly what we got on Friday. The problem is there are two components for the market to process the data regarding inflation and tapering. One component is the jobs report. We got that on Friday. The other component is the CPI report, which we will get this upcoming week. And remember, before we talk about the CPI, the issue of inflation became a political battlefield. The Republicans, on one hand, all of a sudden care about inflation. When their guy was doing it, spending money out of thin air, that was okay. But now that the Biden administration is doing it, all of a sudden the Republicans are concerned about inflation. On the other hand, the Democrats believe that we are a bunch of fools, that if we continue to print trillions and trillions and trillions of dollars to fund all of these programs, somehow that will happen without any inflation. And if inflation happens, it will become transitory. And that leads us to cooking the data. Again, for those of us who were not born yesterday, government agencies have been cooking the data for a long time for political reasons. That happened under the Trump administration with releasing the fake employment report, which was cooked to make the number look better than it actually is. And that was an admission by the Bureau of Labor Statistics. They cooked the number and they blame it on technicalities. And we know that that is bullshit. And now they're cooking the numbers for the Biden administration. And the Biden's administration's favorite recipe is cook us a number right in the middle. Not too hot, not too cool. And this is exactly what they got. Let me ask you this. The ADP report came out earlier this week. This is the private payroll number. It came out at about 1 million jobs created in the private sector alone. Now, the employment report from the BLS, that is the number for the jobs created in the entire country. So are you saying that the private sector created more jobs than the entire country has created? Enough said. We know that inflation is rising all around us. Pay a visit to Costco, for example, and I did that over the weekend. I haven't done so for a month. But pay attention to the ground beef prices. For example, I remember a few months ago, the 3-packs that you get for ground beef from Costco, that was $18 last time I was there. This time around, it was $25. So we know that inflation is all around us and it's not going to be transitory. Because when corporations raise prices on us and that is not met with protests and consumers continue to buy, even at the higher price, prices are not going down again. Likewise, when one company starts paying wages of $20 an hour and the rest follow, wages are not going to go down again. That will become the standard. This is how inflation works. But back to the two components, the jobs report and the CPI report. Last month, the jobs report came out way too cool, with about 266,000 jobs created. Immediately, the NASDAQ blasted higher. The deflationary crowd creamed their pants. You see, inflation is transitory. Inflation doesn't even exist. And you saw the talking heads, the pundits on CNBC and the likes, saying that this is it. This is a green light, that inflation is not getting too hot. And we're back hopping at the NASDAQ, buying the tech stocks, the high multiple stocks, etc., etc. What happened after that? The CPI report came out and it was way hotter than expected, meaning that inflation is rising higher, but jobs are not being recovered at the same rate as inflation is climbing. And therefore, once again, this CPI reading this upcoming week will be the most important CPI reading in at least 40 years. Because the argument is, number one, is the Federal Reserve and Papa Jerome winning by saying that inflation is transitory? They will win if the economy continues to recover jobs and the CPI consolidates and cools off, meaning that if this reading of the CPI is a lot cooler than expectations, then the Fed will win in the eyes of the market. Number two, are we heading into wage inflation? What would support this thesis? If recovering jobs continues to be tamed, meanwhile the CPI reading continues to blast higher and higher and higher, that will pave the way for the wage inflation argument to win. The third argument is stagflation. This will happen if the economy struggles to recover jobs. Meanwhile, the CPI reading continues to climb higher and higher and higher. Now, this is the exact scenario of wage inflation. So what is the difference between wage inflation and stagflation? In the beginning, the assumption will be that perhaps wages should rise higher, and that will incentivize potential employees who are not taking these jobs to go ahead and take them, because we have an enormous amount of jobs openings. But if that doesn't happen, and we see corporations pulling back jobs and the unemployment rate starts to reverse higher again, meanwhile inflation, the CPI, refuses to cool off, that will be stagflation. In my opinion, the stagflation discussion is a little too soon here. It might happen down the road, but for now we have two arguments to face this week. Number one is the Federal Reserve winning. If they're winning, then the CPI report will come out cooler than expectations, but not too cool. If the opposite argument is winning, meaning wage inflation rising higher, then we will see another hot number in the CPI reading this week. And guess what will happen? Everybody will start talking about wage inflation. The NASDAQ will reverse down. Once again, the dollar will rise higher and yields will recover and bounce higher again. Because if the situation we're in, jobs openings are high, inflation climbing higher, but we're not being able to create these jobs to fill these jobs openings, then corporations will have to hike wages. If corporations will have to hike wages, inflation will rise higher. If inflation rises higher, then tapering expectations are pulled back sooner, and we go back to the playbook. Anyhow, that's enough talking about inflation, the CPI, and the jobs report. Let's segue to the other important story for the stock market this week, which is AMC. And boy, are the apes angry. We made a video criticizing the recent pop in AMC's stock, which will not end well, by the way. This is not just an opinion, this is a fact. You know what's going to happen if you understand the mechanics of the market. We have newcomers to the market who do not understand how the market works. They think that stocks can go to the moon, and the number, the price for a certain stock, that means nothing. A stock can go from 10 to 100 to 1,000 to $1 million. The price means nothing. We know that the price is a reflection of a company's valuation. And no, stocks don't go from $1 to 10 to 100 in a week or two. These are unique market conditions during a market bubble, one of the biggest we have ever seen, but that is usually corrected in a very violent fashion. I mean, some of the stuff they're saying is absolutely ridiculous. And it comes out of rumors and TikTokers, Snapchatters, and quote-unquote influencers. And again, some of the stuff is absolutely ridiculous. For example, they say that AMC stock will go to $500,000 a share if they continue to hodl and buy more. This is absolute insanity. If the stock blasts all the way to $500,000, AMC's valuation will be $250 trillion. Ask yourself a question. Are you that stupid? The entire world, global GDP, is about $80 trillion. Are we saying a bankrupt movie theater chain is worth more than the entire planet? But this is the kind of insanity in these chat rooms, the dark alleys of the web, Reddit, etc. And yet another ridiculous thought floating around on Reddit and where the apes gather is the fact that, oh, you gotta wait for the short squeeze, bro, my fellow ape. And that hasn't even started. You're right. The short squeeze hasn't started, and it will never start until you're able to push the stock price perhaps above 150, 200, which is a long shot. And even if that happens, the short float at AMC is about 20%. That went down to about 18% after 2 weeks of massive moves higher in AMC. The apes say if 2% can take us all the way to 1,000%, where the stock blasts 100% in a day, then what do you think is going to happen if they cover the rest of the 18% left in the short float? Once again, that is a fallacy. This is false information. The number of shares traded for AMC exceeded 1 billion shares at some point in a day, meaning that the entire float of AMC is about 500 million shares. So twice the entire available float was traded. And that didn't get you to 500,000. Didn't even get you to 100. But somehow magically the 18% left, if that is covered, that will take us to the promised land of 500,000. Are you a clown? Perhaps you are. And the other thing, of course, the apes invaded the channel, pressing the dislike button. Of course, they're a sensitive bunch. I'm critical of Tesla, Bitcoin, and other assets. And we have viewers who are investors in Bitcoin, Tesla, etc. And yet they continue to listen because they're secure and mature enough to listen to the other side. The AMC apes and the Wall Street bettors, that's a different breed of animal. They're highly sensitive, they're insecure of their decisions, they stay up all night reading comments and watching videos about AMC, refreshing the futures price. It is a stressful gamble. If you are secure in your investment, you wouldn't display that kind of behavior. If you truly believe that AMC will go to the moon, you don't have to attack everybody who has an opposite view. You don't have to stay up all night watching the futures price action. You'll sleep like a baby. You wouldn't care about the opposite view because you know for sure, for certain, that AMC is going to $500,000 a share. And of course, we welcome all the apes, all shapes and sizes, baboons, chimps, gorillas, doesn't matter to me. You're welcome in this channel. You might not be able to take AMC to the moon, but perhaps you can take this channel to the moon, because you know that every time you dislike the video, that actually pushes the video higher in the algorithms. And that particular video became the top performing video for this channel. So I am willing to reward the apes. You know, AMC gave you a bag of popcorn. I'm willing to give you a banana. So every ape in this channel, type in your name and your email, and I will award you a big, beautiful banana in an NFT form. It doesn't really exist, but you know it's there. It exists in your head. I'll just send you a picture of a banana. And of course, to my regular viewers, you know, they are rational human being with functioning brain cells. They contacted me and they said, "Don't let the apes bother you, bro. We're with you. Don't worry about me. I can handle the apes. They're too easy." You trigger them a little bit, they call you a boomer and a hedgy, FUD, and you're just jealous, bro. Stay poor. And they yell and scream for a little while, and then you throw a bunch of expired raw meat on the floor, and they relax. They're easy to handle. And of course, we will cover the chart of AMC during the technical analysis. I know the media doesn't want to cover AMC, specifically CNBC. It seems like they're trying to avoid covering AMC for some reason, but in this channel, we will cover the subject, because it is extremely important. When a huge bulk of the New York Stock Exchange volume come out from one stock, which happens to be AMC, I believe that this is a story worth covering. So we talked about the jobs report, we talked about AMC. Here is the third main story for the week. Elon Musk versus Bitcoin. We're seeing a civil war between the culties. You have the Tesla culties, the Elon culties, versus the cryptomaniacs, the Bitcoin culties. At some point, they were united, and the Bitcoin culties joke on them. We warned them. I've been warning you about this guy, Elon Musk, Elon the Khan. You didn't listen, you trusted him, and now he stabbed you in the back. The cryptomaniacs, the Bitcoin cult, were praising Elon. What a smart guy, what a genius. You know, clowns like Pomp and the rest. Now Elon stabbed him in the back, and he issued this breakup meme that he's over Bitcoin. Of course, he is endorsing Doge, but he also endorsed Cum Rocket. And of course, we saw Cum Rocket erecting higher right away. And then we have another, and this is absolute freak show that we're living in, by the way. I mean, is this a Saturday Night Live parody, or is this real life? Because we have the president of El Salvador. And you know this guy, when he first came out, everybody thought that he's the millennial leader, the new guy who's going to clean up the country, the woke crowd's hero. But now we know that he's another corrupt leader who's muscling his way around the country of El Salvador. However, he's now adapting Bitcoin, and of course he changed his profile picture with the laser beam. I mean, it's absolute freak show, no matter how you look at it. And then we had Anonymous attacking Reverend Elon Musk, because of course Anonymous and other cyber criminals are using Bitcoin as a tool for extortion. But now that Elon is crashing Bitcoin, all of that extortion money is now worth less than it was before. And of course, I'm not shitting on Anonymous. They did some good things before, and I'm 100% behind them attacking the con man of the century. And here's the last thought before we start the normal coverage. They keep talking about sticking it to the man, sticking it to the hedgies. We're beating Wall Street, bro. Meanwhile, Wall Street is making money off their stupidity. But the thought is, if retail traders and investors are united and they continue to buy and hodl AMC shares, it will eventually go to the moon. The problem is, you cannot trust other retail traders and investors because the psychology becomes supreme. An ape starts to stab fellow ape. This is what happened with the cryptos. They were all united behind Bitcoin. And then came Ethereum and Doge and Cumrocket and Titcoin and Crypto Myth and Elon Coin. And now we have all of these cults fighting each other. Likewise, with the meme revolution, you think you're united. AMC, Ape Nation, bro. But Ape Nation will become divided once the psychology take over. If AMC continues to go down, but BlackBerry continues to go higher, they will switch from AMC to BlackBerry because they're not motivated by beating the hedgies. That's the majority, of course. They're not motivated by beating the hedgies or sticking it to the man or because they love AMC. They're motivated by greed, making money. And if the stock ceases to become easy money tool where it's blasting higher every single day, and we see volatility up one day, down big another, that appetite will go away. A lot of apes will take their money out and switch to the other hot potato, whether it's BlackBerry, whether it's Workhorse, whether it's Cum Rocket, whether it's horse manure, it doesn't matter. they will switch, an ape will stab fellow ape. It always ends up this way. Anyhow, that's a long intro. That's a whole video by itself, so let's wrap it up and start with the market coverage. And here we go. The Dow Industrial Average closed in the green on Friday by 179.35 points, or a gain of 0.52%. The NASDAQ closing in the green, leading the pack with gains of about 200 points, or 1.47%. The S&P 500 closing in the green by 37.04 points, or a gain of 0.88%. What about the sector's performance on Friday? Leading the pack at number 1 and capturing the gold medal, technology; at number 2 for the silver, communication services; and at number 3 for the bronze, materials. Meanwhile, the laggards of the day were utilities, real estate, and consumer defensives. Let's contrast that with the performance for the week. Leading the pack at number 1 and capturing the gold medal, energy; at number 2, real estate; and at number 3 for the bronze, technology. Before I forget, yes, real estate won the silver. Meanwhile, the laggards of the week led by healthcare, consumer cyclicals, and industrials. So the week started favoring the inflationary trade, specifically the energy trade. And then as the week progressed, specifically on Friday after the report for jobs, the de-inflationary trade came in favor, that's the technology trade, and the inflationary trade started to fade away. Not by much, but underperforming the tech trade. The question is, after we get the CPI number, will the NASDAQ continue to outperform? That depends on the number. What about the market breadth on Friday? The advanced decline ratio. NYSE 59% advancing versus 38% declining. The NASDAQ 55% advancing versus 41% declining. What about futures? And pay attention here. This is the important part. Was the NASDAQ rallying because all of a sudden inflation expectations went down? The market is not expecting inflation? Of course not, because here are commodities, the main block of inflation, blasting higher on Friday across the board, whether we're talking about softs, grains, meats, metals. It didn't matter. The majority of commodities were surging higher. So before you get confused, let me explain something for you. The market knows that inflation is rising higher. That hasn't been contested at all from the very beginning. But the market wants to know whether tapering will happen sooner or later. It is inevitable. It will happen one way or the other. But if it will happen sooner, then the market will freak out and go back to the playbook. NASDAQ down, the inflationary trade goes higher, so will yields and the dollar index. But if the tapering discussion gets pushed further down the road, then the NASDAQ will blast higher, yields will go down, the dollar index will go down, and you will see the market reaching all-time highs. Because why not party until the party stops? So this is how I interpret the contrast between the commodities market and the stock market. The stock market is partying because tapering got pushed down the road, at least for now, until we get the CPI report. But the market, at least the commodities market, never doubted that inflation will continue to rise higher. Moving on to the big casino, the options market at number 1, you guessed it, AMC leading the pack with about 2.5 million contracts traded on Friday alone. This is, by the way, the equivalent of about 250 million shares, or half of the available float, the entire float of AMC. And about 64% of those were calls. Now, let's address the fallacy of saying that 80% of AMC's float is owned by retail traders, or investors. We know they're not traders, they're not investors, they're just zombies high on meth looking for the next score. But the majority of retail is playing the AMC surge via call options. They're not actually buying the stock. Some are, but a huge number, if not the majority, are playing this via call options. When they buy call options, they're not the one buying the stock. The market maker is buying the underlying shares as a hedge, meaning the power is not in the hands of retail traders, because these options will expire or will become out of the money. Market makers who bought the stock now have the power to play the stock however they want. For example, they own a huge bulk of the shares. If they want to crash the stock and dump it all together, they'll do that. But if they sense that the gamma squeeze is not over, and this is what it really is, it's a gamma squeeze, not a short squeeze. If they sense that this upcoming week there is more appetite for call options buying, they might say, hey, don't dump the shares. If anything, let them buy way out of the money call options, so we will continue to buy the stock and then dump it again. Lather, rinse, repeat. This is how the market mechanics work. A gamma squeeze ends when the stock becomes over-owned, because Because as I explained to you in a previous video, when the stock becomes overowned, in this case by market makers, you reach a point where every single call option bought triggers a sell for the underlying shares, not a buy, as it used to in the beginning of the gamma squeeze. Because a lot of these calls were sold as covered calls, and once the stock hits that number, you trigger selling of the shares, not buying. But do you think the Redditors and the quote-unquote influencers are explaining all of that to their fellow apes? Of course not. They keep egging them on, continue to hodl, continue to buy, and someday we will go to the promised land. How about Apple at number 2? And here comes Apple, a recovery in the options volume. We saw Apple trading at 500,000, 700,000. Now we're seeing a huge comeback for Apple's options, with about 1.6 million contracts traded on Friday. About 74% of those were calls. And once again, the reason why they're buying all of these call options for Apple is the jobs report. If you are betting that the NASDAQ will go higher, then one of the smartest ways to play that move is by buying Apple call options. And this is exactly what I did on Friday. And here it is. Ford Motor at number 3 with about 1 million contracts. About 75.5% of those were calls. And again, you see the names, the meme names, whether it is BlackBerry, Sundial, Microvision, Workhorse, Nokia. This is what I'm talking about when I say ape will stab fellow ape in the back. Once AMC becomes too risky with volatile moves up and down, a lot of apes will migrate, say, to Workhorse, or the possibility of triggering a short squeeze, a legitimate one, is more likely because you have 40% of the float of Workhouse being shorted. What about the unusual trades that took place in the options market on Friday? Let's start by the SPY. They're buying an insurance trade here by the 350 puts, expiration date July 2nd. With expectations, the SPY will drop over 17% by then. They paid about 32 cents apiece to enter this trade. All in all, that brings the total to about $1.6 million. This is most likely an institutional investor who's already up big since the beginning of the year, and they are hedging their portfolio for the worst case scenario. What about the trade or trades for the XHB? This is the Home Builders ETF. We covered this chart a few weeks ago, and I called a top on the chart. We had a topping formation, and as lumber prices started to correct, you saw the XHB also reversing lower. We have more bets for more downside in the XHB. In this case, they opened a put spread by buying the 69 puts and selling the 65 puts with the expiration date of June 25th. And they are expecting the name to drop lower, but not by more than 12%. And all in all, they paid about 30 cents apiece to enter this trade, all in all, bringing the total to about $500,000. What about the trade for the ticker SLV? This is the silver ETF. They're buying the 23 puts. That is very interesting. They're betting against silver. And the expiration date is August 20th. This is a very interesting trade because they're expecting silver to drop over 11% by then, and they paid about 39 cents apiece to enter this trade. All in all, bringing the total to about $600,000. What about the trade for the ticker MVIS? This is for Microvision, another meme name. They're betting for more upside here. It's a heavily shorted name, so once again, if you're looking for a legitimate short squeeze, perhaps you want to visit MVIS instead of AMC, because in this case, they're buying the 24 calls, expiration date June 11th, meaning expiring this upcoming Friday. These are all short-term bets. They're not in love with the company. They're not apes. They're not culties. They're just playing the upside, the mania. And they were willing to pay about $1.75 a piece to enter this trade. All in all, bringing the total to about $2.3 million. What about the trade for the ticker RBLX, Roblox? This is one of the hottest names in the market right now, a huge outperformer since they reported earnings. And again, it is becoming quasi-meme stock. It is not heavily shorted, but it is a name favored by both retail and institutional investors. In this case, they're betting for more upside by buying the 120 calls, expiration date June 25th, with expectations that the name will rise over 20% by then, and they paid about $2 a piece to enter this trade. All in all, bringing the total to about $1.5 million. What about the trade for, here it is, your favorite, AMC? They're betting for a rebound here, a big one. And again, this is a short-term trade. They bought these on Friday. They're looking for a pop on Monday. They make a quick buck. In, out, hello. goodbye. They bought the 54 calls, expiration date June 11th, with expectations that the name will rebound by over 13% by then. They paid about $9.60 a piece to enter the trade. All in all, bringing the total to about $7.2 million. If you think that this is all retail and hedge funds are not playing both sides, think again. Moving on to the charts analysis, and we are skipping the heat map and themes analysis because the intro was too long, the discussion in the beginning, so in the interest of time, we are skipping those. And here it is, we're starting the chart analysis with the apes. AMC, Apes United. What do we see here? A massive pop higher, gamma squeeze, reaching the twin peaks. With 30 minutes perspective, a double top and a double top from an RSI perspective. The momentum peaked there before, and it is peaking here again. You have a bad closing from a daily perspective, from the candle. It looks like a reverse hammer. So the expectations are that the stock will open lower, but it can rebound throughout the day. How low it might go? Well, after hours, the stock is down about 8%, but it could go down all the way to close the first gap at around $30 a share. And if that happens, that will be a good level for a rebound because a lot of shorts who shorted at the top should be taking profits at that point. I will take it from there. The stock goes down to 30, bounces higher. It will all depend on the appetite of retail investors and traders to buy more call options. If they cease to buy call options, and if they cease to buy the stock, because remember, at this point, call options are extremely expensive in AMC. It is not worth it. Might as well buy the stock. Once you get to that point, the psychology becomes supreme. A lot of apes will find BlackBerry, Nokia, Workhorse, perhaps being more attractive than AMC. And this is how the retail mania ends. Psychology. Moving on to the SPY 30 minutes chart, we have a massive gap higher. We are now beyond 420, which is the most important level to watch out for because it is the center of gravity right now, and the chart consolidated around this level for a long time. This was a huge consolidation. The energy has to be released one way or the other. It has to be released to the upside. That is the assumption. This is bullish consolidation, and it should take us to break the resistance of 423. However, and this is a big one, if the SPY cracks below 420 once again, after all of this consolidation, then that will be an ominous signal that the energy will be released to the downside. For now, the assumption is that the energy will be released to the upside, and at some point this upcoming week, the SPY will be able to trade above 423. What about the daily perspective? Once again, the momentum indicators are turning bullish, the MACD and the RSI indicators. What remains is the resistance level of about 4,232. And if we zoom in, looking under the hood, for example, for the 30 minutes perspective, you can see clearly that the chart went all the way to 4,232 to the penny before reversing slightly lower. The battle is not over. This was not a rejection. It was just, hey, I'm knocking at the door. I'm not ready to storm yet, but I'm knocking at the door. This is a warning signal for the resistance level of 4,232. The SPY saying, watch out, you're not going to be resistance for too long. I'm knocking once, about to grab the army next week, and we will blast higher. This is the assumption, not what will happen. I'm an analyst, not a psychic. What about the Qs? 30 minutes perspective. Here it is again, gapping higher, and the Q's been consolidating around 335, 336 for a while. This is the equivalent of the 420 in the SPY. Consolidating, building that energy to blast higher. And the target becomes 340. We're not there yet, but the assumption is that the Qs will be able to climb all the way to 340 from the technicals alone. But remember, we have an important CPI reading. If the CPI reading comes out cool, the NASDAQ will definitely break above 340. But if the reading comes out hot, watch out because the NASDAQ will have a nasty reversal to the downside. Here's the daily chart. The threshold was 13,718. The NASDAQ futures were able to close above 13,718 for the week. That's a win. It has been consolidating, and here comes the energy, breaking above that important level, and the next target becomes 14,000. We had a double top there, so that battle will be extremely difficult. The 14,000 battle. What about the momentum indicators? Turning bullish, not quite definite yet, but starting to look that way. What about small caps? The IWM. We had a small bear flag formation. However, that did not play out to the downside as we expected. And what kept the chart from falling down is the outperformance of meme stocks. Meme stocks are becoming a huge component for the IWM, and so long as they continue to outperform and blast higher, even though we saw the travel names, the reopening names underperforming, the outperformance for meme stocks was strong enough to keep the IWM afloat on Friday. And here is a daily chart for the Russell 2000, still in consolidation range, but the bulls have the advantage so long as we close above 2,264 on weekly basis. This consolidation will result in one massive historic move. For now, the bulls have the advantage, but it is a very close, tight battle. What about the Dixie? What's going on here? We saw the massive pop higher. It looked as if the Dixie is starting to move higher. But once again, here comes the cooked jobs report. The number was good, but not too good. And that pushes the tapering discussion further down the road. And if tapering isn't happening, then print, baby, print. Put that printer machine on overdrive. Papa Jerome printing to infinity and beyond. And therefore, the dollar goes down. But if tapering is about to happen sooner than we expect, then that will recover the currency at least in the short term. What about gold? What's going on here? We talked about gold just like the US dollar. The US dollar popping higher and in return, gold dropping lower significantly. However, on Friday, we saw the inverse picture. The dollar reversing lower and gold reversing higher. And this raises the question, is gold really a reliable hedge against inflation? Why is it rebounding higher when the inflation argument is tamed by a jobs report that came right down the middle? Not too hot, not too cool. Again, the gold bugs keep saying that gold is a reliable hedge against inflation. That is not proven yet. It was the case back during the great inflation of the 70s. The conditions could be slightly different this time around. Why is the US dollar popping higher when back during inflation in the 70s, the US dollar was crushed? We have different dynamics in play here, which is the Federal Reserve, the cocaine operation. Tapering is also coming hand in hand with inflation this time around. That is a major difference between the inflation back in the 70s and the inflation we're about to have, or we're already having this time around. Yields, here it is. We have a nasty reversal here. The chart was looking positive, reclaiming 1.62 basis points as support, consolidating in a bull flag formation. But here comes the kitchen. The number that came out not too hot, not too cool, and therefore yields go down. If we're not going to talk about tapering right now, then perhaps yields should go down. And they dropped all the way to where? The level of support of 1.55 basis points. Now, we've seen this movie before, by the way, last month. Yields popping higher prior to the jobs report, but once the number came out, we saw a reversal to the downside. And again, when the CPI report came out the following week, we saw a recovery in yields. It did not last for too long, but again, this whipsaw, this roller coaster ride, expect more of that, because if this upcoming week we get a hot reading for the CPI, the assumption is that yields will pop higher again, and everything you assumed from the employment report on Friday will be tossed away, because now you have employment not recovering so hot, but we have a hot CPI. We're going to talk about wage inflation. We're going to talk about stagflation. And likewise, if the CPI number comes out cool, not too hot, not too cool, then you're going to double down on the assumptions from last Friday, meaning the NASDAQ blasting higher, yields going further down, the dollar index going down, and you see the high multiple momentum trade back in favor, the ARK Invest, the Teslas, etc. etc. TLT weekly chart, we talked about the level of 140. The chart closed at 139.90, close enough. The momentum is starting to trade positive for the TLT bond prices. But again, I can't tell you one way or the other. I can't tell you buy the TLT because they're about to blast higher. And if they do, that will trigger the short squeeze. And I can't tell you to fade the TLT because we don't know what the CPI number will come out at. Again, bond prices have an inverse relationship with yields, meaning if the CPI report is too hot, yields will blast higher and the TLT bond prices will collapse. And the threshold is 134.5. Breaking below that level from a weekly perspective will trigger the floodgates to the downside. However, if the number is cooling, meaning we get a CPI reading not too hot, not too cool, but trending a little lower month over month, then you will see the TLT popping higher. That could trigger the short squeeze, Could, not must, and therefore I cannot stress the importance of this upcoming CPI number. What about the VIX? The VIX, a nasty reversal on Friday, closing the week once again below 20. Is this bullish or bearish for the market? It is bullish for the market. I know there are a lot of bear theories out there, that this is one massive bull trap and the SPY will reverse, the NASDAQ will reverse, and the CPI will come out too hot, the VIX will pop higher. I get that. But in doing the technical analysis, you have to leave your bias out of the window. The technicals are saying the VIX closing below 20 for yet another week, meaning there is no appetite to buy protection on the SPY in the broader market. That is yet another signal that the SPY will blast higher. If the opposite happens, indeed it will be a bull trap, because every technical signal is saying the market will blast higher. What about Apple? Here's another one. We had the saucer bottoming formation. We're about to be positive for Apple. Apple will blast higher. What do you know? It gets rejected from 125 and we see the bear flag formation. What do you know? That was a bear trap right there. Apple blasting higher once again. We claiming 125. Now, will we open the week lower, cracking below 125, and that would be a bull trap? Who knows? But this is how bull and bear traps work. The charts tell you one thing, but then soon enough it does exactly the opposite. And this is a 30 minutes perspective. It doesn't matter which perspective you're looking at. Daily, weekly, doesn't matter. In this case, it is a shorter term perspective. It was an important level to keep to begin with, the 123.5. Apple defended that and it managed to reclaim 125. Is this bullish or bearish behavior? It is bullish. And therefore the assumption here is that Apple will climb all the way to the consolidation range that it was consolidating at before, around 127 and 128. Lots of whipsawing here, by the way. Up, down, roller coaster ride. You make one assumption, you trade based upon that assumption, and the very next day, you get a smack in the mouth right away. And therefore, you got to stick to your playbook. Do you see inflation rising higher, the CPI coming hotter? You stick with the inflationary trade, you stick with financials, industrials, metals, etc. If you are in the other camp, believing that inflation will be transitory and the CPI number will come out cooler than expectations, then stick with the trade. Technology, high multiple, momentum. Hopping from one ride to the other is what will cause you to lose money. Speaking of, what about the souffle, Tesla? Here comes Tesla from behind. It looked as if Tesla's dead, down about 5% in a single day. After getting rejected from 629, we had bad news regarding the sales in China, investigations, Elon Musk problems, but here comes the rebound, the pop on Friday. Watch out here, because on Thursday, lots of traders bought put options for Tesla. They woke up on Friday and they get a smack on the face. Likewise, on Friday, after the pop, a lot of traders bought call options. What do you know? You wake up Monday morning, Elon Musk is under a lot of scrutiny right now. The man is totally irrational, and Tesla trades down. Up, down, and again, if you are trading tick by tick, you have the chart right in front of you. No pants, like the AMC CEO. You know, the silverback. And you get a big jar of lotion right on the table and you jerk and go off tick by tick, you're gonna get slaughtered. Looking at this chart, what do you see Tesla doing by July, by August? Do you see the chart trading above 679 or below 540? And trade that way. Because if you have a longer scope, you're gonna realize right away if you're wrong and cut your losses. But if you're chasing the daily move, you will get slaughtered. Because the tapering argument has not been settled yet. It might be settled by this week when we get the CPI report. But until then, it will be lots of choppy trading. We are skipping the tulip market because we don't have any updates. The charts pretty much look the same since last time we covered them. They're consolidating, they're bottoming. But again, all of this back and forth with Elon Musk, that's going to impact Bitcoin prices one way or the other. And as Bitcoin goes, so will the rest of the crypto market. You can have exceptions with Doge and Titcoin, Cumrocket, Dog Shit Coin, who cares? But the broader crypto market, led by Bitcoin, did not do anything significantly valuable from a technical perspective. It is trading based on the tweets and the implications from Elon, but the big move will happen if we know for certain whether Elon Musk dumped Tesla's Bitcoin holdings. If that happens, you will see a lot of pain in the name, perhaps breaking the support of 30,000. Likewise, if we see a crash in meme stocks, that could incentivize the apes and the likes to go back to cryptos. And here is the last chart I want to share with you. RKK or Tesla witch Kathy Wood. We had a defined trend, an upward trend going all the way back to last year. I know there are a lot of markings here, but you are a big boy and girl. You can look at this chart without being confused. We have one trend line, positive one, going all the way to last year. That was broken in May of this year. And now we have a negative trend, a negative divergence in the chart. And the question is, will that negative trend be broken and will the positive trend be reclaimed? And this is a massive battlefield, by the way, because it coincides with an important Fibonacci retracement level around 110. The threshold is, if RKK closes the week above 110, reclaiming the trend line, then we will see more gains in the name. And that, by the way, will happen, you guessed it, right after the CPI report. If it comes favorable for the NASDAQ and the mania names, RKK will blast higher and turn positive once again. However, a failure to recoup and recatch 110 by the end of the week and turning the other way, and again, you guessed it, that will happen due to the CPI report coming out too hot, and these mania and high multiple names will collapse. And you and I know that this name, RKK, is the poster child for the high multiple, high valuation names. Every time we talk about tapering and inflation rising higher, RKK doesn't do pretty good. So there is a potential lucrative trade here, a very good one, up or down. I'm not ready to place a bet yet, but I just told you what I'm watching for. 110 and how the chart will behave around that level. And the CPI will be the confirmation. So there is a potential for a very lucrative trade in RKK. Lastly, moving on to the conclusion of this video. What do we have on the economic calendar this week? Tomorrow we have consumer credit. That's an important reading, but not that important. The main event remains Thursday, June 10th. We have the per usual jobless claims, the weekly jobless claims, but the number and the most important reading, the consumer price index. It's a make or break for the market. If the number comes out too hot, then the wage inflation conversation will start, and that will not be good for the NASDAQ. But if it comes down cooler than expected, then you will see the NASDAQ leading the market once again, making all-time highs, and the trade will be buying the big cap technology names, the software names. All of these dips will be bought aggressively. It could not be more important than this. This is the most important CPI reading in a very long time. With that being said, that's all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.